Okay, hello everyone, and welcome back to another edition of Milkshakes Markets and Madness. It is October 6th, and we have just had another, not a totally maddening week, but certainly interesting. And, this is a show where we talk about the financial markets, we talk about the madness surrounding those markets, and we talk about it through the lens of the dollar milkshake theory. And we have some pretty interesting stuff this week related to all of that. And as we get into October here, it's only what 4 or 5 weeks now until the election. And as we get closer and closer to that, I expect both the madness and the volatility to pick up. So what I thought we would do this week is, well, first let me pull up a couple of just things here. I thought we'd just do a quick little recap of what happened. I mean, the biggest news of the week was the non-farm payrolls that came out on Friday. It was a big beat, mostly dominated by government jobs. So maybe not quite as strong as the headline indicates. The ADP had come out a few days earlier, and it was very strong as well. Gold closed at 26.53, so it was basically flat for the week. Silver had a good week, closed at $32. I think it's just shy of the high of the year. Oil had a good week, went from 68 to 74, so it was up about 10% for the week. The volatility index was kind of flat early in the week, but then it had a fairly, not huge jump, but it jumped from like 16 to 20 between Wednesday and Friday, and that caused a little bit of interest in the markets. Equities were basically flat for the week, again, closed near their all-time highs, but bonds were the big story. Bonds were the big story this week because interest rates started to rise again. And that's what I thought we would talk about, because that was actually something that I was pretty interested in. And I was looking for an opportunity to put a short-term tactical trade on fixed income. Now, many people that have heard me talk before know that I like to have an asset allocation for a long-term strategic plan that is kind of set and doesn't change a whole lot. But along the way, I'm always looking to do tactical trades, even if that short-term tactical trade may go against kind of a longer-term view. So this week, I'd been looking for an opportunity to get short bonds because I expected interest rates to go back up. So what I did on Monday, and I tweeted it out right when I did it, but I bought puts on TLT for an expiration, just a short-term trade, 3-week trade. I did it with a 98 strike, paid 75 cents for these puts. Now, part of the reason that I thought we would go over this today is just to kind of show you the thought process that I went through when putting on this tactical trade. Now, this is not financial advice. I am not saying that you should do these types of trades. I'm not saying that short-term trading is the way to riches. I'm not saying that this is the only way that you should trade. I'm just giving you what I did and why I did it. And if some of the reasoning or the thinking behind it kind of helps you think through things when you're looking at your portfolio, well, then that's great. But again, this isn't necessarily a recommendation. It's just I thought it might be interesting to kind of walk through it piece by piece and let you guys think of it what you will, so to speak. But essentially, it wasn't a very popular trade. Surprise, surprise. As soon as I sent it out, of course, I had a number of people saying, why would you do this? The Fed's cutting rates. We're going into a recession. TLT is only going to go up. Even my good buddy George Gammon got in on it. And he basically bet me that he'll take the other side. And he said, I'm going to be down in Medellin with him in January. So he said, loser buys the first round. So, of course, me being, game for just about anything, I said, sure, let's do it. So anyway, but let's go back to more why are you putting the trade on to begin with? What's the point? Well, in very short term, the point is to make money, right? That's the whole point of trading. And tactical trades are not meant to be done with 30 or 40 or 50% of your portfolio. It's meant to be, at least in my opinion, meant to be done with a small percent of your portfolio in a trade that you think has a short term or even a medium term opportunity to add alpha to your overall strategic portfolio. But another one of the reasons why people asked me why I was doing it was, aren't I a U.S. Treasury bull? I'm the dollar milkshake guy. But the thing is I'm not a US Treasury bull. I've never really been a US Treasury bull. Now, I can make a very good argument for why Treasury prices are going to go higher and why interest rates are going to go lower, but I've never really been a US Treasury bull. And in fact, if you go back to the very first time, and I think this is actually a source of much misunderstanding when it comes to the milkshake, is that the milkshake does not say that Treasury prices are going to rise and interest rates are going to go to zero. That could happen, but my thesis has always been that interest rates would go higher because I thought we were nearing the end of the 40-year bond bull market. And I thought that interest rates would go higher and bonds would break. Now, I'm highlighting this because this is just a tweet I sent out, earlier this year, and it's highlighting the very first interview I ever gave on this, where I basically laid out that I thought the 40-year bond bear market or bull market was going to end, and I thought interest rates would rise. It's the interest rates rising that I thought would lead to volatility, which would push the dollar higher, and higher yields in the US pulls capital into the dollar. So this idea that I'm both a treasury bull and a dollar bull is just not the case. And it's funny, I was actually invited this week to participate in a debate, treasury bulls versus treasury bears. And they invited me to be on the side of the treasury bulls. And I had to decline because I said, listen, I'm not a treasury bull. Again, if you want me to argue that side, I can do it. But that's not my main case. That's not my base case. So anyway, so that's part of, if there's any confusion over why I would short treasuries, I'm going to go through and explain a little bit, at least on the short term, why I would do it. But the other thing I would say is, people will say, well, Brent, you don't think the US government's going to go bankrupt? The interest rates are not going to go up? No, but I do think interest rates are going to go up. I do think it will hurt the US, but I don't think it will hurt the US worse than it hurts everybody else. It's not that interest rates can't go higher and cause problems for the US. It's just that higher interest rates cause more problems for the rest of the world than they do for the US. The US is probably the least sensitive institution in the world to interest rates because they can print whatever they need. So this idea that the reason the Fed is cutting rates now is because the government can't fund itself anymore. It's just I just think that's completely wrong. So anyway, that's another thing. Again, interest rates going higher, yes, that's a problem for the U.S., but it's a much bigger problem for the rest of the world. And part of the reason of the whole dollar and treasury thing is, there's this theory called the dollar smile. And that is that when things are going really good, the economy is strong, investments, assets are going higher. And so people from around the world want to, participate in that US market. So they send their capital to the US. But, if they're going to send their capital to the US, it gets pushed into dollars. You need dollars to buy US assets. So in a really strong economy, it's typically good for the dollar. In a really bad economy, then the dollar is sought out as a safe haven, basically because it's the safest in storm, but also because there's so much borrowing in dollars that when things go down, people scramble for the dollar so that they can meet their debt obligations. But there's a point in the middle, kind of at the bottom of the smile, where, it's just neutral. The dollar can go up, the dollar can go down. It's not any big deal. And that's kind of where we're at right now, part of my thesis is that if things are great, then I'd prefer just to be in the US than being anywhere else. If things are horrible, I'd prefer to be in the US versus anywhere else. But if things are just in the middle and everything's fine, then, it doesn't really matter that much. But the point is that I've always been a dollar bull, but I'm fairly agnostic about treasuries. In some kind of a really crazy deflationary scenario, treasury probably most likely rise. But I'm kind of agnostic about treasuries themselves, but I am a dollar bull. So that's just a little clarification. But let's go back to the trade here. Again, even if I was a long-term treasury bull, if there is a setup that I think is appealing, I am happy to do a short-term trade against a long-term thesis if I think in the short term I can make money off of it. And so keep that in mind as you walk through this. Even if you guys are treasury bulls, maybe this will help you kind of see the other side on a short-term trade. So I actually sent this out. Oh gosh, I hate it. I'm going to apologize right here. If you can see this on the screen, when I create these slides in PowerPoint, they look perfect. And then sometimes when they get uploaded to the software that we use for these podcasts, things get reformatted and it looks a little funny. So I apologize if this looks if this looks bad here. I'll explain it anyway. But essentially, here was the thought process for putting on the trade. First of all, I had been wanting to put this trade on for a while. I kind of wanted to do it at the Fed meeting and I kind of missed it. So I was looking for another opportunity to do it. But the other thing is, and so then when TLT was surging on Monday morning, that looked like a good opportunity to me because I didn't think that strength that it was displaying would last. The other thing is I thought oil had the potential to trade higher based on everything going on in the Middle East. I thought there was a lot of economic data coming out, and I'm of the opinion it's not going to be. I think there's a lot of people who think that now that we're kind of heading into this recession and the Fed is cutting rates, that all the data is going to come in. It's going to be bad, and it's going to be misses. And I just kind of felt like things aren't that bad right now. Now they have the potential to get very bad, but right now they're not. And I thought that some of the economic data would be a beat, and and then the other thing was that this port shut down. There was a strike this week, and that had the potential to not just cause a bunch of havoc, but it could potentially push prices higher. And even just the talk of prices going higher could feed into the market. And all of that stuff could lead to interest rates going higher in the short term, because as if inflationary pressures are seen to be not falling and in fact rising, then that would put kind of the brakes on rates going lower and potentially even push them back higher. So so that's kind of the thinking behind the trade. The reason I did options is if you use options, you have a limited amount of risk. You cannot lose more than you put up as a premium. So you can't get wrecked, quote unquote, by buying puts if you do it in a size that isn't going to dramatically hurt you. And the other thing is I always like to do a trade when I have at least one or two catalysts, and preferably more than one or two catalysts that can really, help the trade pay off. And I like those catalysts to be fairly much in the short term. And so with that all in mind, let's look at the setup that I saw Monday morning when I decided to put this trade on. So first of all, we talked about the dock workers strike. So that was kind of being in the news. And I thought that would probably permeate into a number of different news outlets and shows and more in print media. And that would become more of a known thing. And as things become more known, then the more likelihood they get priced into the market. The other thing was the war in the Middle East seems to be expanding. Israel and Hamas and Hezbollah and Lebanon. And now there's even talk of a further complication with Iran. And so that obviously has war always has the potential to be inflationary, but not just that. If oil prices go up as a result of increased tensions in the Middle East, that can in fact inflation. And there's few things in the world that are more inflationary or deflationary than the price of oil. And so because oil was basically at the low of the year on Monday morning when I'm looking at all this, not quite at the low, but very close to the low of the year. So I thought it was very possible that oil was due for a bounce. And then there was just a number of potential the economic releases. We had ADP coming up, we had non-farm payrolls, we had some other releases coming out, some Fed speakers, and so I just thought there was a number of and then next week we've got CPI. So over the next 3 weeks from the time I put this trade on, there's a number of potential catalysts. Again, the sooner they come, the better. And there was a number of things last week that I thought could do it. But if those didn't do it, then I thought there was a number of things this week that could also do it. So I had the prices where I wanted them, and I had potential catalysts lined up. So let's look at, this is the chart of TLT. Now, if you see up here at the top, I show the top arrow showing where the Fed meeting was. And what I want to point out here is you can see for the month or two leading up to the Fed meeting, TLT is going higher and higher and higher. And that's because everybody's, the Fed's going to cut, the Fed's going to cut. You got to buy bonds. Interest rates are going to go lower. When interest rates go lower, treasury prices go higher. But it basically became a sell the news event because it was already priced in. And like I said, I kind of wanted to get short bonds on the Fed meeting, and I missed it. And you can see the day after the Fed meeting, there was a big drop, and I didn't want to chase it. So I've been kind of waiting for a time when prices went higher, and that happened on Monday morning. So when we put this trade on, I think TLT was around 99.50. It was definitely above 99, and I think it was around 99.50. So at the time, also volatility, it wasn't at the low of the year, but it was around 16. And now that's, it's not as low as it's been. It's been as low as 12 and 13 over the last several months. But in general, if you're going to do a trade with options, it's much better to be buying options when volatility is low than when it's high. You want to be selling volatility, and you want to be selling options when volatility is high, like it was back in early August, but you want to be buying options or buying volatility when it's low. So I wish it was a little bit lower than 16, but with everything else lining up, I was happy to buy them at 16. I mean, historically, 16 is pretty low, but just we've had such low volatility the last couple of years that I had wished it was a little bit lower. But other thing, again, oil was basically at its low of the year on Monday morning. It was around 66.50, 67, something like that. But anyway, it was down, and I thought it was due for a rise for what was going on in the Middle East, and even without the Middle East, just oil was kind of oversold a little bit. And then the dollar, the thing I'd point out here too is the dollar was going lower and lower and lower into the Fed meeting. And again, it kind of became a sell the news event. The dollar never went lower than it did the day of the Fed meeting when they decided to cut rates. And I kind of felt like it was getting ready for, again, I don't know that the dollar is going to go to 110 tomorrow, but it felt like it had bounced along the low of the year for a week, and I felt like it was due for a bounce. So that kind of played into the thinking as well. And sure enough, it wasn't that much longer, and then oil bounced. And so you can see that oil, we timed it pretty good. The price of oil went up immediately on the first, and then over the next 3 or 4 days, it climbed even higher. So that would lead to the potential for inflationary pressures. The U.S. dollar index, again, it kind of followed as well. It started to rise. And then volatility, it didn't bounce that much. But again, if I'm buying options and I buy at 16 and then the VIX goes to 20, that certainly helps with the pricing. And then if we go back and we look at the Treasury, the TLT, so the red circle is where I put the trade on. You can see that it was surging that morning, and really by the end of the day, it had already come down. And then the next day it fell. That next day, and here's the other thing: if you can time these things right, the idea is that to put the trade on, and then what I'd like to do is if you're buying options, when you buy short-term options and the VIX is low, if the move goes your way fairly quickly and the VIX rises, the change in prices of the option can move pretty dramatically. So whenever I do an options trade, I'm always trying to figure out, how can I take my initial capital off the table as soon as possible? So we paid 75 cents for these options. And when the next day, or by the end of that day, TLT had fallen, and the next day bonds traded down, those options were now trading for $1.50. So I sold half of them. I think I got out at like $1.45. So I paid 75 cents and I sold them for $1.45. So it wasn't quite perfectly a double, but very close to it. So within 24 hours, because of some of the catalysts that I had seen, I was able to take the initial capital off the table. So now I have all these other catalysts ahead of me. The trade is going my way, and I have zero risk because I've taken my initial capital off the table. So then, over the next couple of days, when economic data came out that was even stronger, so ADP came out on Wednesday, and so it traded down, and then I don't remember what happened on Thursday, but then on Friday with the non-farm payrolls, it took another big leg down. So then on Friday, by that time, now the options had gone up like 3x. So I sold I didn't anticipate this being a 3-day trade or 4-day trade. I anticipated it being, I knew it could pay off within a week. But again, I gave myself 3 weeks for it to pay off because I thought there was enough catalyst in the next 3 weeks that it would pay off. So what we did then is that, when it kind of goes your way that fast, it was kind of surging to the downside. And when things surge, I tend to like to either get in or get out. And so when it was surging lower, I just decided to take the profits and go into the weekend with a nice win. Now, I'll tell you, I'm actually thinking about putting this back on. And so I actually think rates will continue to go up over the next 2 or 3 weeks. And so but nothing goes in, this is another thing, nothing goes in a straight line. Just because it starts going your way doesn't mean it's going to continue going your way. So I think probably this week at some point, rates will pull back a little bit. Bonds will probably bump. When that happens, I might, if the setup is still there, I might buy some more puts for TLT. But that worked out pretty well. So if you look at it here, you can see this is the price of the option. This is the TLT 98 strike puts for October 18th. And again, when we bought them, they were trading around 75 cents. The very next day, we sold half of them. So at that point, we had no more risk. And then, and we still had a number of catalysts, near-term catalysts right in front of us. And then, over the next couple of days, it went from $1.50 to $2.50. And I think we got out like at $2.50, $2.60 or something like that. And so listen, it was a great short-term trade. Now, here's the thing. These don't always work. I'm not showing you this just because it worked, but I'm showing you this because the timing was good. It worked out, and you could see the thought process that I went through to do it. Now, again, I said this at the very beginning. I'm going to say it again now. I'm not saying that you need to be doing these types of trades in your portfolio, but if you do like to do some short-term trades from time to time, I think it's important there's a couple of things that's important when you consider doing that. Think about your timeline. Think about your risk involved, and think about what's going to cause you to be right and what could cause you to be wrong. Now, you don't necessarily have to use options, but if you do use options, hopefully the volatility is low. If you see a good short-term trade, but volatility is at 45, I would be very cautious about doing an options trade because it's very easy for the volatility to come down. Even if you are directionally right, if the volatility falls, you might still lose money, even though you're kind of right. So again, think of a way to reduce the risk. Again, the reason I like to use options is there's only a certain amount of money I can lose. I can't lose more than I put up. And then look for some near-term catalysts, because if you have some near-term catalysts and it goes against you, or it goes your way, you get feedback very quickly. So in other words, it can tell you that you're wrong pretty quickly, in which case maybe you get out, or it can tell you that it's kind of working for you. And if you want to, you can either press the bet, or like I do, just take your initial capital off the table. But, again, figure out how to decrease your risk. You can never completely decrease your risk. Trading involves risk. So you can't completely remove it, but if you can remove as much as possible, that's helpful. Look for a near-term catalyst. And if those catalysts hit, take the profit, take your initial capital off the table. And if you can get some alpha on top of it, take it. Now, the other thing is, you don't do this with 30% of your portfolio. Maybe you do this with 1% of your portfolio or 2% of your portfolio, or whatever it is you're willing to risk. And if you're right, then maybe you make, so we got a double and between 2 and 3x on this, right? We probably risked 1% of our capital, or 0.5%. I'd have to go back and look. But the point is, we turned 1% into 2 or 3%, right? That's not going to change anybody's life. But if you do that trade 4 times a year, if you just do it 4 times a year, now you've got between 4 and 8% tactical profits that are on top of whatever your long-term strategic portfolio is making. And hopefully that helps provide a little bit of alpha. Now, the other thing is, you're not going to get these all right. Hopefully you get 50 or 60% of them right, and you make more on the ones that you're right than you lose on the ones that you're wrong. That's another reason you don't do it with a big percentage of your portfolio. This is, when one happens, I'll go through this and I'll show how it didn't work. Because I have lots of these trades that don't work. But they don't knock me out because I don't use enough capital to knock me out. And you're not going to change your life on one trade. And if you do change your life on one trade, there's probably at least a little bit of luck involved. The other thing I'll say is that famous Jesse Livermore quote is, he says it wasn't his action that made him a lot of money. It was his sitting there watching his long-term positions that made him a lot of money. And listen, I completely agree with that. I don't think that this is how you are going to make the majority of the profits in your portfolio. But what I think it is a way to pick up some extra money along the way. And you know what? It's also fun. And so, you kind of have to have fun in this business a little bit as well. In any case, this one worked out pretty well. I'm pretty happy with the way it went. And hey, George, I don't know if you're watching, but this is a picture of the type of drink I would like when I see you in Medellin in January. So anyway, we got a big week coming up this week, a lot of economic data and a lot of Fed speakers. So I think we're going to have a lot of volatility this week. I think we're going to have a lot of opportunity for some short-term trades. I don't know if I'll do any, but if I see any, I'll let you know what they are. In any case, a little bit of a shorter episode this week, but I hope you all got something out of it. Hope you all have a great week. And, by the way, I meant to say this last week, for everybody kind of in the Southeast that has been hit by this hurricane. And, it's heartbreaking to see the devastation. So if you happen to be in that area or have family in that area, my prayers are for you. Hope you can pull through this and stay strong. Anyway, that's it for this week. Hope you guys have a good one, and we'll talk to you next week. Bye-bye.